Hey guys, how you doing? So Dan from Trading with Dan here. So we're going to do a video looking at what is the alphabet soup of bailout schemes and plans that the Fed has currently got going on to try and bail everybody out in the market, bail out the crony capitalists, bail out the institutions that have acted recklessly with the share buybacks, to bail out the hedge funds that they've been doing via the repo market anyway since September. But yeah, this article is by Jim Bianco. Here's Jim Bianco. He's a president at Bianco Research. He does do quite a lot of good articles that I read. He's a pretty switched on guy, knows what he's talking about in the markets, obviously. So anyway, we'll crack on with the article. So the Fed's cure risks being worse than a disease. So this is whilst this is Yahoo Finance, this is actually from Bloomberg. It's an opinion piece from Jim Bianco that was released on Bloomberg. But I couldn't actually access that, so I found it on Yahoo Finance. So here we go. Right, the economic debate of the day centres on whether the cure for an economic shutdown is worse than the disease of the virus. Similarly, we need to ask if the cure of the Federal Reserve getting so deeply into corporate bonds and asset-backed securities, commercial paper and exchange-traded funds is worse than the disease seizing financial markets. It may be. In just the past few weeks, the Fed has cut rates by 150 basis points to near zero and run through its entire 2008 crisis handbook. That wasn't enough to calm the markets though, so this central bank also announced a $1 trillion a day in repurchase agreements and unlimited quantitative easing, which includes a hard to understand 625 billion of bond buying a week to go going forwards. At this rate, the Fed will own 2/3 of the treasury market in a year. But yeah, so the 2008 playbook was obviously for what was a financial crisis, a crisis in the value of collateral, namely mortgages that were on the bank's book and were obviously a systemic risk to the financial system. It wasn't actually a virus that was physically stopping people from going to work and having the actual real economy in almost its entirety shutting down. So obviously the 2008 playbook is clearly nothing of any real relevance to the markets today, what's going on. But it's alphabet soup of new programs that deserve special consideration. As they could have profound long-term consequences for the function of the Fed and the allocation of capital in financial markets. Specifically, these are, right, we're going to get ready to get tongue-tied here, guys. So the CPFF, the Commercial Paper Funding Facility, which is buying commercial paper from the issuers. The PMCCF, Primary Market Corporate Credit Facility, which is the buying of corporate bonds from the issuer. The TALF, which is a Term Asset-Backed Securities Loan Facility, the funding backstop for asset-backed securities. The SMCCF, the Secondary Market Corporate Credit Facility, which is the buying of bonds and bond ETFs in the secondary market. And the MSBLP, the Main Street Business Lending Program. Details are obviously of which to come on this one, but it will lend to eligible small and medium-sized businesses, complementing the efforts by the Small Business Association. So, to put it bluntly, the Fed isn't allowed to do any of this. The central bank is only allowed to purchase or lend against securities that have government guarantees. This includes treasury securities, agency mortgage-backed securities, and debt issued by Fannie Mae and Freddie Mac. An argument can be made that some can also include municipal securities, but nothing in the laundry list above. So how can they do this? The Fed will finance a special purpose vehicle, an SPV, for each acronym to conduct these operations. The Treasury, using the Exchange Stabilization Fund, will make an equity investment in each SPV and be in a first loss position. So what does that mean? In essence, the Treasury, not the Fed, is buying all these securities and backstopping the loans. The Fed is acting as a banker and providing the financing. The Fed hired Blackrock to purchase all the securities and handle the administration of the SPVs on behalf of the owner, the Treasury. In other words, the federal government is nationalising large swaths of the financial market. The Fed is providing the money to do it. BlackRock will be doing the trades. So this is basically the Fed just giving the government the money to buy everything, and then the government then owns it. So it is basically the same as the Fed buying it, but the government owns it. So it's literally, they're both basically merging together. In 2008, when something similar was done, it was on a smaller scale. Since few understood it, the Bush and Obama administrations ceded total control of these acronym programs to the then Fed chair, Ben Bernanke, Helicopter Ben. He unwound them at the first available opportunity. But now, 12 years later, we have a much better understanding of how they work, and we have a president who has made it very clear how displeased he is that central bankers haven't used their considerable power, i.e. a printing press, to force the Dow Jones Industrial Average at least 10,000 points higher, something he has complained about many times before the pandemic hit. When the Fed was rightly alarmed by the current dysfunction in the fixed income markets, they felt they needed to act. This was correct though, but to get the authority to stabilise these private markets, central bankers needed the Treasury to agree to nationalise, i.e. own, them so they could provide the funds to do it. So basically, the Fed can't buy them directly, but the government can, and so they just basically lend the money to the government and then the government buys them just because they can't buy them directly. But it's the same thing. They're basically providing the money to buy them. So money has just been printed to buy them. In effect, the Fed is giving the Treasury access to its printing press. This means that in the extreme, the administration will be free to use its control, not the Fed's control, of these SPVs to instruct the Fed to print more money, so it could buy securities and hand out loans in an effort to ramp up financial markets higher going into the election. So why stop there? Should Trump win re-election, he could try to use these SPVs to get those 10,000 Dow points that he feels the Fed has denied everybody. So if these acronym programs were abused as I described, they might indeed force the markets higher than valuations warrant, but it would come at a very heavy price. Investors would be deprived of the necessary market signals that freely traded capital markets offer to aid in the efficient allocation of capital. Malinvestment would be rampant. It could also force private sector players to leave, as the government's heavy hand makes operating in controlled markets uneconomic. This has already occurred in the US federal funds market and the government bond market in Japan. So what it means, this is obviously everyone knows the Fed has been suppressing interest rates basically since 2008. Interest rates have been lower than they should be for longer, not where the free market would have them, which is why we have this massive expanded credit bubble. So massive debt everywhere, 253 trillion globally, because money has been too cheap. So corporations, governments, people, everybody has borrowed money because basically there wasn't a real price of money for people to have to then consider the paying back of. So it's sort of a no-brainer because the Fed was already manipulating. So what they're trying to say is that then if the Fed then manipulates stock markets as well, then it's just there will be misallocation of capital again in the same way. So Fed Chair Jerome Powell needs to tread carefully to ensure his cure isn't worse than the disease. So that's it really. So basically what they're saying is welcome to your new Fed chairman, Donald J. Trump. Basically, he's going to be in control of the printing press. He's already got rates at zero. So there you go. So anyway, so there's not financial advice. I'm not a financial advisor. Always do your own research. And then and I'll speak to you guys soon.